Let's take a look at this chart. It's the outcome of Nifty intraday system over the past 10 years. And initially a capital of 3 lakh rupees grew to approximately 19.6 lakh rupees in this case. But now let's check this chart. So basically here we are using the same strategy. At the same time here 3 lakh rupees became 25 lakh rupees. So what made the difference? Well, it's ATR, average true range. If anyone asked me, Nataraj, what is the best indicator for intraday trading, without any secondary thought, I would reply ATR. ATR is the simplest method to boost profits and minimize the losses, ultimately enhancing our strategy's performance. And we can utilize this wonderful tool in 4 different ways, and that's exactly what I want to focus in this video. By any chance, if you are new, I'm sending a real-time intraday alerts of Nifty and Bank Nifty on my Telegram channel. If you don't want to miss them, the link is in the description. Feel free to join. And also, recently I have published a book called Mastermind of Day Trading, which basically focuses on core principles of rule-based approach towards intraday trading. The book link is also in the description. It is now available on Amazon and Flipkart, so you can check this out. It could be a best reference for your intraday trading journey. So let's get started. Well, let's start our video by understanding what exactly ATR is all about. Let's take an example to understand this theory. Assume you are analyzing a historical data. For example, on the first day, the total range, high-low difference between any particular, it could be a daily time frame, it could be 5 minutes, it could be 15 minutes. So in this case, let's assume you are looking into the data of daily time frame. So first day, 30 points range. Second day, you saw the range of 40 points. On the third day, range of 50 points. The fourth day, it was 60 points. On the last day, fifth day, the range is 50 points. So when you combine all these numbers and calculate the average, you will get a specific value. In this example, it is around 46 points. And when we are calculating ATR, we factor in a variable called period. So basically, this term refers to the number of candles or bars we look back at to calculate the average range of data. So in simple words, this tool helps us analyzing the market volatility, and this particularly is useful for intraday trading, where understanding volatility can be a game changer. Now, let's try to understand how potentially we can use this particular indicator in order to enhance our intraday performance. Well, let me ask you a simple question here. What's the most critical element that leads to the success in intraday trading? Well, the answer is volatility. First of all, intraday trading doesn't benefit from gap ups or gap downs, so you cannot expect big momentum in your direction. So as long as our primary goal is to capture the maximum momentum within a day, obviously we need volatility, which is only possible in a volatile market. But the question is, how do we differentiate a volatile market from the non-volatile one? That's exactly where ATR fits in. Well, let's put this into practice. Open tradingview.in and here navigate to the super chart section, where you will be able to see the advanced sections of the charts, and select a 30-minute time frame here. Since we are focusing on very short-term trading, we are basically using 30-minute chart here. And next, this is an important step. Click on the indicator tab, search for ATR. And here, select the average true range indicator. When you apply it, it should look something like this. Now, you will find the indicator setting here. You can change the setting according to your need, but I won't be changing anything here. By default, ATR is set to 14 period, which means it looks back to the past 14 candles to calculate the range, average true range. Once this is done, let's click on the indicator again here, and this time let's search for EMA. So which will help us to find the exponential moving average, and just click on it. Go to the EMA setting now and change it to 50. Then click OK, and the most important step now is to drag this moving average, which is on the main chart, to the ATR window. Once you've done that, you can see now the moving average indicator in the ATR window. And now go back to the moving average setting and change the source from close to ATR. This is very important step, and this will draw the average, moving average directly on the ATR. And now the actual concept begins. As long as the ATR is above the moving average, we can consider it as a volatile market. Similarly, if the ATR is below the average, it indicates a sideways, non-volatile, or kind of a choppy market. And as per this information, it all makes sense for us to implement momentum strategies or trend following systems in the volatile condition market. I think it's better we understand this with a real life examples. Here you can see. So here in this case, ATR was above its average and we got the very good trending moves. Similarly here, where the ATR was below the average, and in this time we got the choppy kind of a movement. There was not much of a momentum in the market. And logically, we can utilize this information in 2 different ways. In a volatile market condition, we can deploy the breakout systems. In a non-volatile market conditions, we can use non-directional option selling strategies such as straddle, strangles, or even pullback or mean reversion system also would work better when market is non-volatile. By the way, if you want me to upload a video on breakout trading strategies, type breakout in the comment section. Based on your interest, I'll plan the content. And the next step is stop loss. Basically, it's the most crucial element in any form of trading, just not intraday trading. However, if placed incorrectly, it can work against us. You might find yourself exiting trades too early, even before the move has begun. Therefore, incorporating volatility into setting our stop loss is also absolutely important. This is where the second use case of ATR comes into play, which is setting stop losses. Now, let's assume you are entering a long trade with an entry value of 20,000 here. This is an example. Apply the ATR indicator now on a working time frame. That means, for example, if you are working in 15-minute time frame, so you will apply the ATR to the 15-minute time frame itself. To set your stop loss, now it's an important step. Simply subtract the ATR value from your entry price. But in this case, the key point is to multiply the ATR because it allows adequate room for your stop loss. That's why it is important to multiply ATR value to calculate the stop loss point. For example, if the ATR value is 50 points, multiplying it by 2 makes it 100. From your entry price, which is 20,000, subtract this 100 points and you set your stop loss to 19,900. And most importantly, the same theory can be applied to trailing your stop loss as long as market moves in your favor. Let's say the market moved 100 points in your favor in the same trade. Assume that it is trading at 20,100 now. So if the current ATR is say about 55, simply multiply this by 2, which is around 110 points, and subtract this from the present price, which is 20,100. So you set your new stop loss to 19,900. With this scenario, even if the market reverses its direction, your loss would be around 10 points in this case. So basically, you are significantly reducing your risk compared to the original 90 points risk. Let's take an example of a short here. Suppose you are entering a short at 20,000 rupees, and in this case, apply the ATR indicator to your working time frame, which is 15 minutes in this case, and for setting SL in the short trade, add the ATR value to your entry price. So we are going to multiply the ATR 50 multiplied by 200, and you can simply add this to your entry price 20,000 plus 100, which is 20,100 is your stop loss. And again, this method also useful for trailing your stop loss once the market moves in your favor. For example, if the market moves down by 100 points, that is in your favor, around 19,900 the current price is, and ATR is 55. In this example, 55 multiplied by 2, which is equal to 110 points. This makes your new SL for the short trade to 20,010 points. So even in this case, market reverses, you are going to secure your profit. So basically, you reduced your risk by 100 points to 10 points. Let's take some real life examples. Here is an example of a recent long trade where after entering the trade, the system trailed the stop loss according to the market's volatility. Now let's take a look at the short trade example here. So this is how it looked, and this is how we placed our stop loss in the recent short trade. Point 3, when it comes to intraday trading, obviously setting precise target is absolutely crucial, especially having an understanding of a momentum and the magnitude of the momentum. For example, you are entering to certain price and how far market can move in your favor. So if you have an idea about that, you can plan your trade in a better way. This is where the third use case of ATR comes into play, which is target setting. To set a target in intraday trading, we use the daily ATR value. For example, on tradingview.in, you can add a simple ATR indicator, but this time instead of 30-minute time frame, we are looking into the daily time frame. Let's say you plan to trade tomorrow, you would check the today's ATR value. Assume in this case, yesterday's ATR was around 200 point, approximately in Nifty. If today you enter long at 20,000, you can directly set a target of 200 points. So making your target at 20,200 makes sense for that particular day. So when market reaches to your target, you have two different options here. Either you can close your trade immediately, or what I basically prefer is that trail your stop loss aggressively. So assume in a short trade scenario, if your entry point is 20,000 and target is 200 points, when your target becomes 19,800. When the market reaches to this level, similarly adjust your stop loss accordingly. So basically, you can exit the trade or you can aggressively trail your stop loss. As you can see in this example, observe how the daily target level was hit in this particular candle specific movement, and once that happened, you can clearly see how the initial stop loss was aggressively trailed. And my friend, this is how we capture the maximum move when the market is in our favor. Last but not the least, it's basically using ATR for dynamic position sizing. Unlike normal position sizing where we might enter certain fixed lots for some money. For example, let's say 2 lakh rupees, 2 lots, 5 lakh rupees, 5 lots. Or we may use a percentage based stop losses as well. But utilizing the ATR allows us to optimize our position sizing according to the volatility of the market. So how to do this? Very simple, with the help of daily ATR. Assume today you are again checking the daily ATR, daily time frame ATR, and it is around 100. To determine the position sizing for tomorrow's trade, whether volatility is short or long trade doesn't matter. You can divide the maximum risk amount that you are willing to risk by this particular ATR number. For example, if you are prepared to risk 5,000 rupees and the daily ATR value is 100, you can divide 5,000 divided by 100, which equals to 50. So by opting for 50 quantities in this particular trade, you are ensuring that your risk is limited to the volatility of the market, and also you are positioning yourself with respect to or in line with the volatility. Here's another example. Suppose the volatility increases and the daily ATR is now, instead of 100, it is 200 point. Now again you have to do the same thing. 5,000 rupees you are ready to risk, and you divide it by 200 rupees, which gives us 25 points. Therefore, by taking 25 quantities in this trade, you adjust your position sizing to the higher volatility. Now it's time to look at some real life examples. Basically, I tested one of my intraday strategies on Nifty using a fixed lot size. So basically in this case, I'm using 2 lots. That means 100 quantities, 3 lakh rupees as my initial capital, and it turned into 19.6 lakh by the end of 10 years. However, same strategy, same method, same initial capital, I tested with ATR based position sizing, and now the result is completely different, and the result was nearly 25 lakh rupees. That's around 25% increase in the performance of the same strategy. Well, those are the 4 ways you can utilize this amazing ATR indicator tool for intraday trading. I hope you found this video helpful. If you did, please like and share it, and your support is always a great motivation for me. That's all from my end for now. I will see you in the next video. Until then, take care. Bye bye. Jai Hind.